Hello, my name is Niël Pretorius. I'm the CEO of DRDGOLD, a gold producer in South Africa, listed on the Johannesburg Stock Exchange and also on the New York Stock Exchange.
Niël, thank you very much for the introduction. Good to see you again. My goodness, what a busy time in the world. Metal prices are all over the show. The gold price was hit a low in November, I think, about 1650, and then it was up at around 2000 again in late January or early February. Then it's dropped like a stone, and it's back up again. I mean, it's all. It's a pretty exciting time if you're a follower of the gold market.
Absolutely, and I think finally more than one region is really involved in this, or are involved in this, and influencing gold price trends. In the past, I think what we saw that whenever gold sentiment the conditions for gold was poor, and gold sentiment was poor, there was nothing catching the gold price, and it would go down a lot. And now suddenly there's a second region with an appetite for gold. So as quickly as the United States and the West are dumping gold, they seem to be absorbing gold, and they seem to have some sort of a value threshold where they would be happy to get in and buy whatever was being offered. So we saw massive gold flows towards the east, away from the West, and even from countries like Switzerland during exactly that time that we were referring to, October, November of last year. And now, of course, that sentiment's changed a little bit again, with a dynamic that nobody saw coming, with the collapse or the risk of collapse of banks. Suddenly again, there's pressure to provide liquidity and to provide comfort to the United States economy for the integrity of that banking system. So suddenly renewed doubts in the integrity of fiat currency and another surge in gold. So you want to hold some gold regardless.
Last year was very much the story of the kind of the east, the central banks buying gold, kind of Russia and China, and non-Western central banks were all kind of in there. In fact, central banks in general, and yeah, this financial instability, this fiat currency. I've been talking about it a while to anybody who'll listen. My family is extremely bored of me talking about the risks of fiat currency. I bet you've got a fiat currency chat in you somewhere there.
Oh, absolutely, and more and more people are saying that the only real currency is gold, and everything else is credit, and then you've got to assess the quality of that credit. And then one does get the sense also that there's certain jurisdictions that are positioning themselves for a challenge to the dollar as a reserve currency in terms of energy, in terms of oil, and in terms of gold, and maybe sort of more broadly as well. And maybe what's one of the reasons why we're seeing them buying up all the gold, buying as much gold as being offered for sale. We know that China's already buying oil in their own currency from countries like Venezuela. So, and Venezuela is one of the largest producers of oil. So, increasingly, I think they're going to start forcing their suppliers into buying in Chinese currency and move away from the dollar as a reserve currency. Saudi seems to be taking an interesting stance as the United States. So one doesn't know where that's going to go. But I mean, it's what they're doing almost is through what they're insisting on in terms of trade is that the oil is pegged to Chinese currency. Now, what if they start doing that also in terms of gold? And they say, well, we declare that 1 ounce of gold is worth so much in renminbi. And what's that going to do to the dollar? So, I think these are interesting times and interesting dynamics. And gold does seem to play an integral role in how all of this is being played out, how these strategies are being pursued, if they are in fact deliberate strategies that are being pursued. But one begins to sense that they are.
Well, let's park the macro for now, and I will want to come on to South Africa because that's another layer of macro. But just on DRD itself, I love the fact that you're the stock exchange's oldest continually listed company doing the same business. Although there has been a change in the business, so you're no longer deep underground mining, but you're kind of processing and rehabilitating the above ground stockpiles. But could you just kind of give me a snapshot of how the recent months been, kind of what the trend is on the operational level and on the operational level of the company and the finances of the company.
Yes, I think you would have seen that our volumes are down ever so slightly compared to where they were the previous comparative period. So although the gold price has been really good, and that's been good to revenue for the period, the most recent period that we reported, you would have seen that there was an increase in revenue. It was actually all slightly lower production and also lower tons. So we are at this stage having to deal with the impact of weather on tonnage delivery. We are having to deal with the transition from sites that are getting depleted onto new sites. There are one or two regulatory issues that we've got to deal with licenses that have been years in the process, and that were supposed to have been issued or to use this licenses, and these have been delayed and regrettably. And what one can start with listing all of the different reasons why they haven't been issued, but it's a frustration. Maybe 3 years not enough time to consider these licenses, but it's that overlap of transitioning from older sites onto newer sites and having them almost overlap so that the lower tonnage or depleting sites could be made up from newer sites. So that's something that we've got to deal with. There have been a few issues also in terms of electricity supply. The mining industry does not get interrupted in terms of their electricity supply. They have to curtail consumption. But there are a few reclamation sites we've actually transitioned across since December on those sites also into the national grid, but there were a few local council supply points or municipal supply points that serviced one or two reclamation sites where we in fact had load shedding. So these were 3 or 4 dynamics impacting simultaneously on tonnage delivery. It's not the start of a new trend. These are events over a period of time that will ultimately be resolved. So we hope to be back to sort of normal throughput by early in the new financial year, sort of June, July, assuming that we will finally get the regulator to apply its signature to the 2 licenses that we do require for those particular sites that are fully equipped. They're standing there, the pumps are there, the pipelines are there, everything's done. It's a matter of throwing a switch and then production will begin.
Can I just to clarify, these events, these challenges you're talking about, and the period when the volumes are down, correspond to, am I right in thinking it's a 6-month period from kind of the middle of calendar 2022 to the end of the calendar 2023? Calendar 2022.
Yes, no, it will overlap into this 2023. Yes, it's financial 2023. So up to June of this year. So we should see volume throughput resume back to normal levels. Hopefully by not later than June of this year, July of this year. And as I say, that's not for lack of infrastructure or lack of having available resource. It's quite literally just. And then in fairness to the regulator, this particular regulator, we designed emergency spillage dams at 2 of our new reclamation sites in a particular way. And on their final inspection, when they were basically having their sort of final checklist before issuing the license, which was in October of last year, they said, but we actually want these to be designed slightly differently. And then we did the change in design, and these aren't significant infrastructure. It's about the size of a tennis court, or maybe just a little bit bigger than a tennis court. It's an emergency spillage dam that's designed to trap spillage in the event that there's a power interruption at the reclamation site itself. So these had to be lined, and that amended design had been submitted to the regulator in 2022, late last year. And we're really just waiting for them to consider the amended design, and then this thing can go forward. And they have until the 14th of April to consider that. Now, unfortunately, being a State Department, they will use every day within the sort of the statutory deadline. They would say, well, this is maybe one we could do a little bit sooner, and we'll surprise them and issue it in January. So we hope to be up and running hopefully in May, but not later than June. This is anything like more or less, it's a few 100,000 tons a month. So the impact is there to be seen. It hasn't had the effect that we didn't see positive cash flow. So there's still positive cash flow. We can still take advantage of the high gold price, but it's annoying because you know that there's about 30 or 40 kilos of gold that should have landed on the table out of the targeted 450 kilos, 480 kilos, and it's not there. So it's really annoying to know that it's there for the taking and it's not finding its way into the plant.
It may be annoying, but if you look at your share price, I mean, your shares were below $5 on the ADR on the Nasdaq. They were below the $5 in September, October last year, and they're now above $10. And so, the market's not punishing you for this, or rather, the market is rewarding the leverage to the gold price.
Absolutely, and I think the market also sees it for what it is, that it's not the start of the trend, that it's essentially an event, and it just needs to be dealt with. And and I think the investors who invest in South African stock, they're used to hearing stories about load shedding and about all sorts of other challenges. So this isn't a horror story for them. They know that this sort of thing happens from time to time. I'm more annoyed with myself not having anticipated it sooner and having dealt with it better. Because typically when we have a depleting site and a new site, we do have that overlap. And this time we just allowed it to get away from us a bit. So there's a 2 or 3 month period where otherwise there would have been a more seamless overlap between two sites.
Okay, but you hope by the second half of this year you'll be back up and running smoothly. What I took away from the last interview that I did with you was the kind of the culture of continual performance within DRD. The fact that you have to keep those pipelines, the slurry pipelines running, because otherwise they solidify. The fact that you're talking about continual processes and your management culture is about kind of continual improvement. That word continual I keep repeating, but it's kind of a management culture that was so integral to the way that you work. And has does that just I mean, I know it doesn't just happen, but you've got some disruptions on the operational side, plus you've got disruptions on the kind of your country level. How does that integrate?
So I think this particular mindset amongst our operational management stock that's many years in the making. Nobody's here or very few of the members of senior management and sort of finding its way into the part of not being involved in this business for less than 10 years. Some of them have been here for 20 years, 30 years. So they have a skill set which I think breeds a sort of a natural intuition of what it is that they see in terms of the general health and status of a circuit, which I think is really valuable. There is a very specific way that we deal with information as well. So monitoring takes place by way of continuous monitoring. We do not do spot checks. You have the kind of instrumentation in terms of tracking performance in terms of a number of key dynamics. That's really extensive, and these give you data not on a sort of on an interval basis, but on a continuous basis. So you see a graph in terms of volume throughput, in terms of densities, in terms of pH, in terms of the pressure and the temperature in the elution circuit, and so forth and so forth. And the plant is continuously managed. The entire system is continuously managed towards those dynamics to stay within range. It is a business that you've got to manage proactively. So there's a key to awareness of that sort of thing. I think we also took a decision many, many years ago that we will manage the business towards the risks that can impact its long-term sustainability. So longevity isn't something that we pursue. We invest the right sort of capital to deal with some of the risks that we know will manifest over time. These are risks associated with water. We very seldom talk about water, but South Africa is a dry country. We have access to the largest underground lake in the FIAT province, which is the one that was created by the mining industry. You just have to look at an approximate 800 million to 1 billion tons of mine waste sitting on top of the surface, then you know how large that cavity is. And that cavity is filled up with water, and we have access into that. And that's our main supply of processed water. So it's grey water mostly. This is something with a decision that was taken many, many years ago. The same applies to extensive automation and mechanization that I just referred to, that we run 24/7. The fact that we've had backup systems in place now for many, many years, close to 50 megawatts of backup system in terms of diesel generators, that's just to keep the process in motion, not to serve as fully fledged backup in the event of a blackout. But we're supplementing that now with a 20 megawatt solar power station and battery capacity, storage capacity, and that'll be increased to 60 megawatts over the next 3 years. So those are further measures that we took. If you look at security at our operations, it looks completely different compared to what it looked like 20 years ago. There's a different kind of risk, and therefore you had to design your security completely different. A lot of reliance on surveillance, on early detection of movement, on proportionate response to risk, on not taking disproportionate risk in terms of the staff that you deploy to look after infrastructure, rather have them monitoring monitors as opposed to standing there on site with a torch and a radio. That used to be the practice many, many years ago. So that's how you maintain proportionality. So it's recognizing our environment and managing your investment towards those risks. The only way to avoid the risk is not by avoiding risk. Sometimes you have to manage risk, and you do that by investing into very particular systems. And those are all for COVID for us, for example, I think was a very good illustration of just how deeply rooted resilience had become in the DNA of this business, when for almost a month, senior management was managing by remote control. And then the business did really well. Now some people are saying maybe that's grounds for reorganizing the business, but it's actually not. It is just indicative of how the design and the system over time had developed to a point where when the biggest crisis that had hit the global economy in decades hit, this business, and not by design, obviously, but simply because of the way that, not by design for this particular incident, but simply just because of the way that it had been set up towards disruptive risk, was in fact capable of continuing. You want to have an automated business when there's a pandemic raging now, and that helped us. And that's why I think it's so annoying that we missed this overlap thing. You know, we don't want to have overlap between a depleting site and a new site, and it's a frustrating time because it's a bit of an embarrassing time for us, the fact that we haven't intercepted this and that we now have to explain to the market why on a monthly basis we're producing 30 or 40 kilos less gold than what we're supposed to be producing at this point in time.
Well, I think you've been bailed out. You've been bailed out by the gold price, so that's certainly helping in the short term. But
it's really. But I mean, it does. Sorry to cut you, but it does help to an extent. But you know what we say to the market is we set up the business in such a way that we can see that we can maintain a holding pattern during tough times, but that we can take full advantage of higher gold price, and we're not taking full advantage. That's the annoying part.
Again, perhaps it's not my role. I should be here asking the difficult questions, but if you've got room to optimize by another 30 or 40 kilograms in the months ahead, surely that's a selling point today. You're talking about managing risks, and that kind of brings my thought process onto South Africa as a whole, because it's your operating environment, and presumably you're taking steps to ensure your ongoing resilience for any wider countrywide challenges. But your commentary on what's happening in South Africa at the moment, and with particular reference to your operations, would be appreciated.
Yes, certainly. So I reflected briefly on the situation with water. Now, water is not something that you can allow at the feet of the state or government. because potable water shouldn't be used for processed water. So I think what we've done in terms of water supply, making sure that every day there is that 30 million litre top-up that we could draw from a grey resource, that's something that we did months ago. But what became apparent was that a number of other aspects, for example, the security, electricity supply, etc., quality of training for that matter, that this was just too much for a government that was increasingly dysfunctional and that it lost touch with its own reality of where it needs to invest and the things that it needs to put into the effect. On the electricity, I think the best illustration in that regard is just the spiraling electricity utility, namely ESCO. And I think it's, I think if you anticipate this, or if you, even if you don't anticipate it, if you come to terms with the fact that that is your reality, it is possible to engineer solutions for those risks. Because, as much as South Africa is eating the headlines in terms of dysfunctional politics and a poor investment environment from a political perspective, the private sector and the people of South Africa, I think, are completely different. We have a robust, innovative, dynamic, and influential private sector. So there's a lot of capital going around in South Africa. We have people that love South Africa, and because of what it offers, and who are determined to preserve that which we deem precious, and we want to extend and roll it out to every South African. There's not an enclave mentality. There's an inclusive mentality from the most prominent of corporates all the way down to the most distant of communities. So that's the South African dream. It's unfortunately not one that's shared by most politicians. Politicians get voted in because they create some sort of a phantom risk, and they offer themselves as a solution to that risk. So I think South Africa is sort of developing into, let's call it a state where the politicians, they make their noise and they do their things, and they pretty much trip over their own feet, trying to preserve their power base, whilst the rest of South Africa is moving forward and finding solutions. And I encourage you to go and read about a little town, a small town in the Free State, that has become almost a beacon of what this alternative model looks like. It's a little town of Frankfurt, where the community is gone, and this is an inclusive community. It's not along racial lines. It's not along access to capital lines. It's an inclusive initiative where they've gone and they've created I think it's a 3.5 megawatt solar power station, which feeds into the entire community. They have 12,000 customers, and they've only had 65 customers cut off because of non-payment. So this culture of non-payment that's being told about, it's not a culture of non-payment for services. It's a resistance movement because the services are non-existent, and that's why people don't want to pay. They're not going to pay for something that doesn't get delivered or that doesn't get provided. So Profitably is that, and now, typical of a government that is desperate to hold on to the remaining bit of influence that it has over the economy. They're wanting to interfere with Frankfurt in the supply of electricity to its 12,000 customers by enforcing their load shedding schedule and disrupting the supply of electricity from the solar farm. So that's the tension that's happening in South Africa. It's a battle that you don't read much about, but I'm afraid the innovation, just the dynamic, intelligent nature in how the private sector is pursuing all of these solutions. Government's no match for it. The state's no match for it. It's a losing battle, and they might as well just accept defeat and surrender all of these strategic things to the private sector. We're talking about health. We're talking about infrastructure, security. Well, the security is actually a bit of a contentious one. You don't want private bombings. It's unfortunate that you have to hire people with specialist skills to look after your staff and look after your infrastructure. That really should be the role of government. Government should have the monopoly on violence, or else, the other side of the coin is equally true, that you could have crime cartels who could also become too influential and too powerful. But in terms of all of these other things, I think the private sector has the capacity and shown itself to have the capacity to move forward. They can overcome the gaps and close those gaps that have opened up because of a failing ANC government. And we can set the country back on the road to recovery. And it's phenomenal potential. We're sitting, and that's the reason why we're investing all of this capital. Part of that shrinking margin that you referred to, or free cash flow margin that you referred to, was because of an acceleration in the amount of capital that we're spending. So the confidence that we have is based not just in our own ability to fix this or be part of the solution, but it's also because of the quality of this ore body. It's simply too good an ore body to turn your back on. It would be disgraceful if we allowed all of this value to remain unexploited for the benefit of our own stakeholders and also for the broader economy. And that's why we'll keep on investing in this.
Sorry, which ore body are you referring to there?
Our reserve base. So the
stockpiles.
The other stockpiles that we have. Sorry, we refer to it as an ore body. We protect the real miners and not mud puppets. But so the 6 million ounces that we have at our disposal, which we can feed, we continue to invest in its optimization, and we will continue to do that until ultimately it becomes truly unbearable. And truly unbearable will mean when it becomes too unsafe, not because of anything other than becoming too unsafe. And that's where we're hoping government will step in, maybe just deal with some of the violent crime trends that we're seeing in South Africa.
So looking forward for the rest of this year, so you've got effectively 9 months for the remainder of this year. Yes, you want to get those licenses in place, and so you can start on the two new reclamation sites. But could you just talk me through kind of what the rest of the year looks like in terms of kind of gold's deliverable that you'd like to kind of be measured against by the market?
Yes, our financial year is it ends at the end of June, so it's about off calendar financial year end. And we had, up until now, we haven't had cause to change our guidance. So although gold production is slightly lower, or tonnage throughput is slower, what you also do find with these depleting sites, because these are the lower levels, is that grades are typically higher. So recoveries have actually been really good, and they've partially offset some of that. We do have our costs firmly under control, and we're not seeing any cause at this stage to change our guidance that's out in the market. And then, of course, as I said earlier, hope to early in the new financial year pick up on some of those volumes again, and then maybe next year start testing the higher range of the guidance that we issue. But we sort of mid-range in terms of guidance.
Remind the listener in terms of ounces, please.
I think it's about 170,000 ounces that we gave in terms of guidance. And as I say, we own that cause to adjust our guidance. You would have seen recently when we released our market uptake for the quarter that we didn't see occasion for an adjustment to that. Not for the quarter, for the half year rather. Our results for the half year, we did not see cause to adjust our guidance. Sort of mid-range of guidance.
Good. Well, thank you very much. I look forward to hearing those numbers when they do come out, and good luck with getting those licenses in a couple of weeks. I mean, it's only 10 days away, the 14th of April.
Well, we hope so. We hope they land, and once they do, I'm going to be there personally to hit the green button so we can start.
Thank you very much.
Thank you so much, brother.